Welcome to another edition of King Size Conversations. I'm your host, Brian Pfannes, president here at Steel King Industries. This is a virtual edition, so this will be a first for us. So feel like we've got some technical bugs all worked out, but looking forward to trying this out today. I will be joined here, or I am joined here with Pete Henry, vice president at Paragon Steel. Welcome, Pete. Thanks for joining us today. Pete is the vice president of Paragon Steel. He's a respected leader in the steel service center, steel industry space. He's here today to talk to us about what's going on in the marketplace. I know our customers often wonder and have questions about the things that drive commodity pricing, the things that drive our cost of products, and how things kind of work, and what is the inner workings behind going on in the marketplace today. Clearly, it's a volatile space. Pete has been known for his practical approach, deep market knowledge, and commitment to customer success. Works closely with customers like Steel King and other suppliers, core mills out there in the space. Paragon Steel has a trusted reputation of providing high-quality flat-rolled steel products and processing services throughout North America. Beyond his professional services, he takes a great pride and approach to building relationships across, not only with our customers like Steel King, but across the industry as well. I'd like to welcome you, Pete. Thanks for joining us today.
Great to be here. Thank you.
Anything you'd like to share about Paragon, the Henry family, anything with respect to your business before we kind of dive in?
Sure. Well, as you mentioned, I kind of grew up in it, and I tried to escape it, once or twice, but the family was pulling me back in. So we do have several different steel-related divisions, headquartered primarily in Northeast Indiana, around Fort Wayne, Indiana, and Butler, Indiana. And with our respective divisions, it has helped us at times, I think, navigate the larger economy just in terms of information coming in because we are working with and handling different products. So, Midwest Pipe and Steel was a little bit more known for long products, structural steel, so bars, angles, beams, heavy duty plate. And I'm more of a flat roll guy myself, steel coils. And that's really the focus, of course, of Paragon Steel. So Paragon does have two large coil processing centers in Northeast Indiana. But when I talk to the team and our respective managers, it does help at times to glean some insight regarding what's happening in different markets. Even if, say, for example, the plate market is very hot, there are some instances where then maybe flat rolled is not quite as robust at that time. So there are some market environments where I think having the respective groups gives us a little bit of a broader perspective on the industrial economy and the steel market overall.
No, I think your diversified portfolio and background is outstanding. I think, and will provide a great perspective for our listeners, for our customers, and our competitors if they're tuning in, which is possible. Hello. So let's dive right in. So first, for our listeners, before we get started, a little disclaimer. So what we talk about today, please don't go out and trade on our behalf. Our attorneys would prefer that you not, and then I would prefer that you not. But we're going to talk to you about our perspective and where we sit in a respective marketplace today as a customer and then as a supplier. But as we know, the metals market is extremely volatile, and things change from a tweet to any geopolitical action around the globe. We're a small piece in that very large machine. So Please don't trade on our behalf, but we'll dive right in. So for our listeners who don't live in the steel market space every day, how would you describe the U.S. steel environment right now? Is it mainly a demand story, a supply story, or a tariff story, or D, all of the above?
Great question, Brian. At this point in time, sitting here in July, it's D, all of the above. And I think it's helpful to think back to the end of last year, Q4 2025. The industrial economy in general, looking at some of the indexes and things, was pretty soft and demand was definitely down. But as we came into this year, things did start to pick up a little bit. However, I think early this year in 26, we would have described it as more of a supply driven phenomenon. So I think one of the most important things to think about right now in steel is the United States is net short on steel, meaning we consume more than we produce. We produce something like 90 million tons and consume over 100 million. So if we think back to what was brewing, say in January of 26 or the very end of 25, I think there were a lot of large steel buyers out there who realized that the tariffs seemingly were going to remain in place. And having a 50% tariff on carbon steel is a very high hurdle. And of course, anything coming into this country, which used to flow in a significant way, up to several million tons a month. So many large buyers effectively replaced imported tons with some domestic procurement initiatives. They realized that it seemed like the tariff regime was going to stay in place, at least for the first half of, say, 2026, and they did not want to be paying 50% tariffs. So they looked to buy more domestically. And as the first quarter, I think, gathered some momentum, it became clear to us that some of the incentives, for example, that were in place in the Big Beautiful Bill definitely were contributing to some economic momentum. So specifically, uh, there were some tax cuts in the Big Beautiful Bill and accelerated depreciation. And
Does data center growth play into that too?
absolutely, absolutely.
Thinking about it, you wouldn't think
Yes.
centers would consume a lot of steel, but from what we see and what I hear, what I read, it definitely sounds like there's a lot of steel consumption being dedicated to that space.
Yeah, for sure. Yeah. So I think, by late spring, we really started to see a lot of, I mean, massive demand, much of it coming from the construction space, much of it related, of course, to these data centers. So when we think about how big some of these data center projects are, they become something of a construction site as the ground is prepared before the big data centers are indeed built. And of course, they require immense amounts of power. So that then feeds into the power generation sector. So we've seen stronger demand from companies like, say, Caterpillar, earth moving equipment, to clear the ground and to get these construction projects underway.
It's used around cabinets and I mean anything in the electrical space, conduit, all of it, right? I mean, there's There's a whole host of metal that goes into, quite frankly, all sorts of alloys that go into that space.
Absolutely massive demand. Absolutely massive demand. One, go ahead. One interesting forecast that we saw, apparently, Goldman Sachs came out in the last month or so, and they have an updated forecast regarding the spending that these hyperscalers are gonna undertake in the next few years. So Goldman Sachs is now forecasting a spend of $5.3 trillion dollars between 26 and the year 2030, related specifically to the data center build out. It is a massive number. And then again, when we think about how many other steel related products kind of touch this story, you've got heavy equipment, you've got power generation. So literally power plants are being built. Some smaller nuclear plants are being built. The electrical grain oriented steel, there is huge demand for that product. So again, s- thinking about the kind of steel that you guys use, Brian, essentially right now we're all kind of competing for steel with some of these hyperscalers is one way to think about it. And very large utilities who need the grain oriented steel, which is still produced at the same flat rolled mills.
Right. So from a product portfolio standpoint, I mean, just educating, I think of steel like, well, it's gray and it rusts and all that good stuff, but um, it's so much more than that. I mean, all the various grades. I mean, grain-oriented steel, and what does that mean? The efficiency of power, being able to run power through a power line, way more efficient than traditional commodity metal from, say, 50 years ago. Maybe that kind of opens the door a little bit. So Steel King, we use hot rolled carbon, just like everyone else in the racking space. Our grades of metal are a little bit different. We won't touch on that today. We like to keep that close to the vest, but we meet all of the RMI standards that are required. But we do some other things there in that space, providing what we believe is a little bit better value to our customers. But if the mills are given the choice to choose between standard hot rolled carbon structural steel versus being able to run something that is a bit higher value add with higher margins, and of course, then they transition. If their pipe is limited to a certain mix, only allowed so much, and there's a shortage in the marketplace of steel, then they may go and opt to run a different mix that's a little bit more profitable, so to speak, or lean in a way that curtails some of the basic hot roll carbon tons. Is that a fair statement?
Yes, definitely.
So looking at AISI, or American Iron and Steel Institute, is kind of the call it the primary source of statistics in steel production. Raw steel production capacity utilization rates right now are roughly around 80% or thereabouts, which is up quite a bit from pre-pandemic, et cetera, pre-tariffs for sure, and has been holding higher. Production rates are up 4.3% over 2025, according to those numbers, or according to AISI. Question for you is when we look at those higher production numbers and capacity utilization rates running so strong, how is it possible that there could be tight supply or tight availability? And how can that production just be falling short? I think you alluded to it a little bit, but if you could kind of put it into a bow for me, what does that mean?
Yes, for sure. Lack of imports and accelerating demand.
Sure, and the lack of imports. I mean, you kind of when I was buying it for the last, before I was in this seat, managed our steel supply chain, all of our supply chain. And when market pricing went crazy, there was always a need for some degree of balance, and imports played that role at various peaks in the cycle or points in the cycle. With imports being kind of blocked out today, that prevents or creates a challenge a little bit if there's basically a capacity shortage. Do you anticipate that capacity shortage changing over time? I know domestically there's some mills that are going to be coming online. Nucor's got a mill in West Virginia that will add a considerable amount of tons here in some point in 27, starting to bringing those tons online.
Yes. Yes.
Do you see other things coming to bear to add more domestic production capacity? And I say domestic because here at Steel King, we believe in made and melted in the U.S., and we continue to buy made and melted here. We did it before it was cool, as I tend to use as a tagline, but we'll continue to do it into the future. So what do you see kind of the next couple of years look like for capacity, both near term, long term? Do you see capacity easing, or we have some more chop and turbulence that we got to work through?
That's a tough question looking further out. But more immediate term, I think it's a great question. And one thing that has worked to tighten the market right now as we're sitting here is there are a couple maintenance and upgrade projects underway right now. For example, U.S. Steel has their largest single blast furnace down for a planned reline. So they're essentially just refurbishing their largest blast furnace. Blast furnaces have, some utility life there, and they needed to make some repairs. So the market was aware of this. They were transparent about it. But nonetheless, at the moment, the second largest blast furnace in North America is down for repairs. And the forecast is it's going to be roughly 100 days. So our best estimate and our contacts are suggesting that blast furnace should be back up in the September timeframe. So that'll help significantly. So late spring, as we sit here right now, that worked to tighten the market quite a bit. But that furnace will live again in a big way starting this fall. So we think roughly by the fall timeframe, as that furnace comes back up, and as some import starts to return to the United States, we think that could help balance the market a little bit this year. And then, of course, as we look into next year, you're right, Brian. The big story is Nucor is building a brand new state of the art steel mill in West Virginia. So that'll be 3 million tons of domestically made and melted in West Virginia. Those tons will be welcome, and that'll help alleviate some of this tightness.
3 million tons is a big deal by any shape or any measuring stick for sure. But I mean, if we're running a deficit of 9-ish million tons in a market that is starting to accelerate a little bit on the consumption side, even with those coming online, capacity likely to remain somewhat constrained, assuming there isn't a lot of other changes that take place. My question to you, kind of on a close here, but for Steel King's customers, pain point is often not just price, it's confidence. And as you mentioned, the challenges in the metals market, can I get that metal? That's our issue. Can we get the metal? For our customers, it's when can it ship? And how long will that price be good for? And so if I had to go to our sales team and have a conversation with them, and you were sitting there, I mean, is there any advice that you could give to our sales team and or to our customers about the realities of what are going on in the marketplace and just being honest. Like, we're not trying to make excuses here, um, but how to be honest with the customer about the marketplace. And maybe just a couple points to that. And then I'll follow it up and say the benefit of having more insight into what's coming and the opportunity to engage with supplier partners to manage this material supply chain set of challenges over the next several quarters. How critical is that to success for everyone? So, I mean, if you could kind of bracket those, that'd be great.
Absolutely. Yes, I think that is critical looking forward to kind of manage the volatility that we're all experiencing right now and some of the supply chain challenges. And to me, it all gets back to the importance of relationships. Your long term customer and supplier relationships become all the more important in these market environments that are either very volatile and or very tight. So on our end, for example, we have several different annual contracts, and we've been working with some of the same steel mills for decades now. And, there are times, of course, when the market is weak and they're really leaning on us for for hopefully to come up with some additional demand and to support them. And likewise, right now, it's a very supply type market. So we are leaning on our steel mill partners to deliver for us on a monthly basis and to keep us in communication regarding upcoming supply outages, regarding potential political and or policy modifications that could happen out there and or any innovations in the market space. So I would say, Brian, for me, the most important thing is to emphasize and to really focus on those relationships, work on building those, and being there for your customers, of course, but then also your suppliers and having a broad view of the market, given that we are going to have some ups and downs. And regarding, I think it was a great point about just being honest with your customers, what's happening in the marketplace right now, because I really do think we're living through some interesting times. There these numbers that folks are talking about in with the data centers. I can send you some charts after, Brian, that you could share if you're interested, that I've just seen from various financial analysts. And if this spending continues, it might not be anything that the economy has seen since the railroad era. Um, and I do think we're going to continue to see more reshoring. So again, this is a changing industrial landscape as it seems that tariffs on steel and aluminum are set to remain. The USMCA may or may not be renewed. We may end up with a two-track situation, perhaps one with Mexico and a separate situation with Canada. So these are major changes that are evolving right now. So to me, it's that staying close with your key customers and suppliers and to really share information on what's happening in the macro economy. And one other thing I would add, if I could, real quick, is why is the market so tight? Is it just data centers? While that is the biggest driver, there are still a couple soft pockets out. So, for example, we haven't seen agriculture really take off as much as I think some of the agriculture manufacturers would have liked to have seen. Automotive seems flat-ish, but not super strong right now. So when I take a step back and I think about automotive, we know the housing sector is still a little bit soft. To us, this is what we would describe as a capex driven cycle, as opposed to a consumer driven cycle. So, why is the steel market so tight right now? You've got AI data centers, but again, you've got some large capex spending that's going on out there. And we have seen some of the indexes improve, some of them notably. For example, the ISM manufacturing PMI hit 54 in May. That was the highest reading since May of 2022. Another one that we keep an eye on is the Chicago Business Barometer. That one hit 62 and change in May, the highest since apparently January of 22. So there's obviously some other things that are going on in the market in addition to just data centers. And a couple areas that we have seen tick up a little bit would be the heavy truck market. So thinking like big Volvo semi trucks, Freightliner trucks. They were in a cycle low last year in 2025. This year their numbers are up over, I saw one article up some 200% year over year. Another sector that would make a little bit of sense that is a big steel consuming sector in some pockets of the United States would be oil and gas. So we have seen the rig count improve a little bit. It's not super strong right now, but I had a note here. I think it's up to 580 on the rig count. So that's the highest in, I would say, I think it was something like maybe 2 years or 13 months. I have a note. I'm sorry, 13 months at least. One last area where there's definitely some demand would be the defense sector. So globally, we've seen, a lot of activity in that space, which doesn't directly impact the United States. But when we just think about steel being consumed globally, obviously there's been a big effort, for example, in Germany to, um, undertake more spending in the defense sector. And obviously there's a lot going on in that part of the world. And the current administration is looking to increase our military budget here in the United States. So there's going to be some steel that goes into some of these components related to defense. So I just wanted to give a couple specific sectors in addition to the data centers where we are seeing incremental improvement at least. Data center, exponential. A few other sectors, incremental. And then when you think about there's less steel coming into the United States, hopefully that helps just give the listener a little more perspective on why these steel prices are so high and maybe poised to go a bit higher.
You brought up a great point about capex driven cycle versus a consumer driven cycle. And I think back some of the previous spikes that we've seen in the marketplace. I mean, you talked about automotive. Automotive's, as you said, is flat. Historically, when automotive kicks off, they would drive the market, right? I mean, no
Yes. Yes.
consumes such a huge amount of metal in the United States. So when the consumer gets back into the space of buying and replacing cars, which they continue to keep aging at a ridiculous clip, I mean, besides the price of how much they are and call it interest rates. But once that buying cycle starts to kick off, hopefully we're through the capex driven cycle and back into a little bit of parity on both. I'll close on this. I mean, I think if I heard you correctly, the big thing here is partnerships. And here at Steel King, we value partnerships both with our suppliers, much like yourself, and the various mills that support your company. And key to have great communication and do what you say. And so, like, I think about your comments really hit home about demand being in a weak market. I think back to the beginning of the pandemic, and In 2020, when we didn't know what things were going to look like, I want to say one of the very first phone calls I made was to your guys' organization, and a conversation that was had with the salesperson that manages our account. And I said, I don't know where the market's going to go, but we believe in this relationship, and we're going to hang around, and we're not going to cancel our blanket POs, and we're going to stay. We don't know what we're going to do with it. We don't know how we're going to handle it, but we trust you guys, and we're going to hang in there. And that helped us in call it demand-driven tight markets, because we were taken care of. The mills respected it. You guys respected it. I think we're in that point now again, as you mentioned. And so, like, having key partnerships matter. We like to talk about a built-to-deliver supply chain here at Steel King. The other thing that comes, I think, and sticks out is, call it the managing of the pipeline. Various opportunities within the pipeline, how we can partner with our customers and provide line of sight on these big projects to make sure that we're covered and make sure that everyone is able to have capacity that's managed correctly, and call it take risk off and provide peace of mind. I mean, for us, we're not the lowest cost provider in the marketplace. We never have been, don't want to be. That's because we enhance on value and making sure that we can execute in even some of the toughest driven markets out there. So many great points, Pete. I really appreciate your time today, and I welcome to King Size Conversations. Look forward to engaging you a little bit more and your expertise. Maybe we can do this in person at some point, but really thank you for your time and insight today.
You're most welcome. Great to be here.
Thank you. And for those of you that are out there, if you have any topics that you'd like us to touch on or any feedback that you'd like to provide to us, please feel free to reach out to us either on LinkedIn or Facebook, or provide in some details and comments. I know our marketing team is paying attention to what's going on and would love to get your feedback and potentially build it into another conversation here in the future. So appreciate your time today, Pete. Thanks again, and for all of our customers out there, we'll keep being steady and strong, and looking forward to supporting your business in the days, weeks, months to come.